Modern financial markets are completely dominated by high-frequency algorithms, executing trades at speeds invisible to the human eye. This is a reference sheet mapping out smart money concepts, or SMC. It is a highly specialized lexicon created specifically to track the footprints of these algorithms across trading charts. Most retail traders fail to utilize this framework because they treat it like a vocabulary test. They attempt to memorize these acronyms as a list of isolated static patterns. This terminology represents a formalized syntax. It is a mechanical language used for mapping institutional order flow and engineered liquidity. To extract the actual utility from this framework, we have to discard rote memorization. We are going to reconstruct this cheat sheet from the ground up to reveal a unified algorithm of price delivery. The value of this lexicon lies in reading the sequential sentences these terms form on a live chart, tracking the precise logic of algorithmic execution. We begin with the foundational assumption of technical analysis. Price moves in sequential stair-step trends. When an uptrend pushes past its previous peak, it establishes a break of structure, BOS, confirming institutional intent to drive price upwards. Eventually, this stair-step pattern fractures. Price drops oppressively below the previous structural low, resulting in a change of character, tagged as CHOCH. While a BOS confirms trend continuation, a CHOCH serves as the critical early warning sign of shifting market momentum. These structural tags dictate the direction of the trade. However, they completely fail to explain why the reversal happened in the first place. To understand the origin of a reversal, we have to stop looking at the line of price itself and start looking at the empty space above and below it. Within the SMC lexicon, liquidity refers strictly to large pools of resting retail stop-loss orders. These order pools naturally accumulate at specific historical price levels. Two prime locations are the previous day high, PDH, and previous day low, PDL. Classic retail patterns naturally engineer vulnerable liquidity pools, as traders place tight stop losses directly behind equal highs and equal lows. Conceptually, we group all these structural levels into two categories: buy-side liquidity, BSL, resting above the current price, and sell-side liquidity, SSL, resting below. Algorithmic price delivery is magnetically drawn to buy-side and sell-side liquidity. It absorbs these exact resting orders to fuel large institutional positions. This brings us to a mechanical question. What exact event triggers the sharp change of character we established earlier? The initiating catalyst is the liquidity sweep, or LS. The mechanics of the sweep are highly efficient. Price wicks aggressively over a key level, triggering retail breakout buyers into entering long, while simultaneously stopping out early sellers. This provides the exact opposing volume required for massive institutional short entries. A valid structural shift, a change of character, carries high probability only if it is immediately preceded by a liquidity sweep. The target and the trend reversal are inextricably linked. We can now examine the anatomy of the aggressive downward move that forms immediately after the liquidity sweep. This drop's velocity creates a price inefficiency called a fair value gap, FVG. Institutional selling drops price so fast that buyers are bypassed, creating a vacuum. If extreme volume physically separates the candle bodies, it forms a volume imbalance, VI, leaving a liquidity void. These gaps act as a structural imbalance. Algorithmic price action is drawn back to these zones, eventually returning to trade through the empty space and rebalance the ledger. To measure these zones mathematically, traders calibrate to the consequent encroachment, or CE. This is the exact 50% midpoint of the fair value gap. The fair value gap provides this specific mathematical footprint, confirming true institutional participation rather than a spike in random retail volume. By tracing this impulsive, inefficient move back to its precise starting coordinates, we locate the origin of the cycle. This is the order block, or OB. It represents the exact location where institutions injected capital to engineer the liquidity sweep. If this block fails and price cuts cleanly through to test it from the opposite side, it becomes a breaker block. Regardless of the variant, the critical rule remains. An order block is valid only if it directly caused a break of structure or a change of character. For precision entries, execution is typically calibrated to the mean threshold, or MT, representing the 50% mathematical midpoint of the order block itself. An order block is the physical origin coordinate of the entire structural algorithm. We can now combine these isolated terms into a single, continuous, predictive cycle of price delivery. The sequence begins with the hunt. Price moves up to sweep buy-side liquidity, initiates a sharp change of character, and leaves behind a clear fair value gap. This initiates the retracement and mitigation phase. Price pulls back to fill the gap at consequent encroachment, cleanly tapping the mean threshold of the originating order block. This provides the fuel for the final expansion phase. Price drives aggressively downward from the order block, specifically targeting the sell-side liquidity resting beneath the equal lows. The SMC reference sheet is a blueprint of interdependent dependencies: sweep, shift, imbalance, mitigation, and expansion. Mastering market microstructure requires abandoning static definitions. Success comes from weeding the continuous, cyclical narrative of institutional price delivery.